Hello, I'm Kim Warren, and in this presentation I'd just like to summarise the possible contribution that strategy dynamics can offer to the aspiration to achieve integrated reporting for companies' performance and results. And what I intend to cover is, first of all, to explain a little bit about the background to integrated reporting and why it needs an integrating framework to make it possible to fulfil its aspirations. Then I'll explain the strategy dynamics process using an example and draw out from that implications for any attempt to do external analysis on a business and for integrated reporting itself, including the desire that many stakeholders have to identify social and environmental impacts of what companies get up to. Now, this initiative is being led by the International Integrated Reporting Council, which includes regulators from many jurisdictions and senior figures from many of the world's largest and most influential accounting firms. And in their consultation draft of the integrated reporting framework, they describe an integrated report as a concise communication about how an organisation's strategy, governance, performance and prospects in the context of its external environment lead to the creation of value over the short, medium and particularly the longer term. But of course, this is not the only body or the only group calling for improvements in corporate reporting. There's all kinds of other calls to get away from the short-termism that is thought to have caused such damage in recent years to the global economy. So in this consultation draft, there is a proposal that an integrated report should include the following items of content: an organisational overview, comments on the governance of the business, opportunities and risks it faces, how strategy and resource allocation are carried out, how the business model works and what this does for recent performance and for the future outlook for the business, which are of course very worthy and important aims. But it's not easy to do, and the report goes on to say that it requires integrated thinking, which it contrasts with traditional silo thinking, and that takes into account the connectivity and interdependencies between the range of factors that have a material effect on an organisation's ability to create value over time. Now, that's a good thing to want to do as well. The challenge is, how exactly do we do it? Because that's not an easy requirement to fulfil. Now, at the heart of the thinking about this lies this business model framework, which starts on the left-hand side with the inputs that are used by a business, and the report categorises them according to the so-called 6 capitals model: financial, manufactured, intellectual capital, human capital, social relationships and natural capital, which are then worked upon by business activities to generate outputs in the form of the products and services that are delivered, and outcomes in terms of both internal and external outcomes. Internal being issues such as sales and profits, of course, but external being impacts on the society in which organisations operate and the external environment. And of course, those outcomes can be positive and they can be negative. Positive ones are growing cash flows and negative ones are damage to the environment. And what the business model struggles with is that between those inputs and business activities and the outputs and outcomes that it generates sits this thing called the business system, which has got all these interdependencies in it, both within the firm itself and beyond the boundaries of the firm, out into the marketplace in which it operates and at the social and natural environment. Understanding those interdependencies and how the business system actually works requires that we specify those inputs and those business activities on the left-hand side in a form that we can actually figure out what the business system is actually doing and how it's likely to perform. The problem we face is that current approaches to strategy, business models and performance fulfill neither of these needs. They don't specify those inputs and activities in a way that you can work with quantitatively, and they don't specify how to understand the interdependencies and what they do. Now, this is not easy to do, and the reason it's not easy to do it is that business system includes features that are just genuinely difficult to deal with. First of all, the business system includes critical factors that accumulate over very long periods. It takes years and decades to build a customer base, to develop the product range you want, to build a company's reputation. So that means you get big delays from actions that you take to the results that actually come out from those actions. And you can end up with consequences continuing for many years, if not decades, after you made the decision. So if you did not hire junior people 10 years ago, you have not now got people with 10 years of experience in your business. If you did not develop a pharmaceutical product 10 years ago, you don't have that product in your product range to generate sales today. And that means the decisions we're taking now will continue to have consequences for many years out into the future, if not decades. And that's not reflected in short-term assessment of companies' performance. Then you've got interdependencies in the system. Multiple choices need to be right on multiple issues all of the time. So if we want to win more customers and grow our sales, we've got to have made all of the right decisions about the product range, about building our sales force, about marketing and sales efforts, and to have done so over long periods of time. Then you get the complexities arising from feedback mechanisms that apply all over the place. Changes can accelerate themselves and kind of run away with themselves over time. Good ones like word of mouth feedback generating exponential growth in your customers and sales, but also bad ones. We can see in the collapse of some companies after the financial crisis how an initial deterioration in the business actually just gathered pace and accelerated away until the businesses fell apart. And a different kind of feedback results in things that would otherwise be favourable, making progress for a while, but then they just stall. You just cannot continue making the improvements that you wanted. And the last feature of these systems is that they include thresholds. Good changes that you have made, good decisions you've made, seem to do nothing for quite a long time until you reach a tipping point where, let's say, a product has been improved to a point where customers are actually willing to give it a try, or we get bad surprises and service quality deteriorates and customers put up with it for a while until it gets to the threshold at which they say, well, that's just unacceptable. And then all of a sudden you get the bad surprise of losing customers and losing sales. Now, fortunately, the method known as system dynamics deals explicitly and quantitatively with all of these mechanisms. That is precisely what it was designed to do. And that's the method that lies behind this approach to understanding the link from strategy to implementation to performance. Now, the strategy dynamics process is simply the application of that system dynamics method to questions of strategy and policy. And here are the simple stages to go through. First, you specify past and desired future performance and how that changes over time. Secondly, you work out how changes in business resources drive that performance, and we take care to properly define and quantify those resources. Thirdly, we look at why those resources accumulate or deplete at the rate at which they do. And lastly, we identify the impact of interdependencies amongst those resources and the effect that our decisions have on that process. Now, by the time you've put those four pieces of the method together, what you end up with is a working, quantified model of the system that drives performance. That turns out not to be quite enough because there are some extra things that you have to add to the method. Customers and other resources vary in quality. We have customers who buy more or buy less. We have staff with more or less experience. We have products with more or less appeal. Some resources need to develop through stages. There's a customer development pipeline. There are different levels through which staff develop. We clearly have to compete for customers and compete for sales to those customers, but we may need to compete for scarce and valuable staff in addition. And then, of course, we have to deal with intangibles like reputation and staff morale, and we need to deal with the capability. We need to understand what a capability actually is and what it does to the performance of the business. But you can get a very long way simply by going through the first four steps and getting to that picture of the core system. Why do we need better strategy tools? Well, let's take a very simple example of the low-fare airline Ryanair. The reason we take this example is, first of all, everybody understands the business model. Secondly, it's a completely focused single activity firm. And thirdly, and most importantly, of all the information we need, all the data we need to actually do this work, this company and companies in this sector get as close as any to publishing everything you need to do the work. Now, the first point to note is that no amount of financial analysis alone can explain that result on the right-hand side of this page, or indeed give any sense at all of what future prospects are going to be. You could pore over the financial numbers forever, it wouldn't tell you anything significant about what was likely to happen in the future. Nor can you get very far by looking at what's known as the strategy positioning of the business over on the left-hand side. This business focuses on cost-oriented travellers. It offers low-price, reliable travel to many destinations, and it uses low or zero-cost airports and new efficient aircraft to do all that. Now, the reason that is only a very limited help is that it doesn't really explain performance very much. More than 50 other airlines in Europe have tried the same thing. Most of those have failed. And furthermore, the positioning of this business hasn't actually changed in over 15 years. It's been doing this thing in that way for all of that time. And similar limitations apply to common ways of thinking about business models, value propositions, and other strategy tools. And the reason that they can't help us very much is that they are nearly all based on static principles and very often provide only a qualitative treatment. In any case, the leading business models textbook, for example, doesn't report a single number for any of the business cases that it discusses. So we need something to fill in those question marks in the middle. What exactly happens to get from strategy to performance? And success comes, in this case and every other case, from building and sustaining some very simple resources. This airline has progressively added more and more cities to the destinations that it serves. It's added and closed airports around those cities. It's added and closed routes between those airports. It's hired and retained lots of staff. It's bought and sold aircraft. It's set fares and marketing, not just in general, but for each of those routes, for each of the times of day and week throughout the year. And it's done all those things consistently well over very long periods of time, with the result that it has been able to win and retain the customers that generate the revenue that it enables it to deliver that profit on the right-hand side. And if its future performance is going to continue to be strong, then it's going to have to carry on doing those things just as well as it has in the past. So here is step one of the process. We start with a time chart of what the performance has been and what it might be in the future. History matters a lot. As I mentioned earlier, decisions we took many years ago continue to be reflected in the business performance right now, and decisions we're taking right now will be reflected for performance in many years out into the future. Of course, we're not immune to external factors, and this company, like others, was affected by the 2008-9 recession, although this company survived it quite well, while others were driven into losses or failure. And then we look out into the future and we say, how could we achieve a strong future in which things continue to go well? How can we avoid a poor future in which the system starts to fail? So that's step one of the process. This example happens to focus on profit growth for this company, but we can deal with multiple performance aims as well. So we might have objectives to do with social and environmental impacts too. We need a method that can deal with either kind of objective. So when it comes to profit, we simply start from the income statement. This is the company's income statement for the 12 months to March 2012. And there's nothing particularly mysterious about that. That's a very standard income statement for a company in this sector. And what we're going to do is lay those same numbers out, but in a causal set of relationships, running from fares and passenger journeys on the left-hand side of the picture through to profit. In this case, earnings before interest, tax, depreciation and amortization on the right-hand side of the diagram. Now that's just a snapshot for that particular year, but if that's true for the year ended March 2012, it's also true for every other year both in the past and out into the future. So here is that same diagram, but now we've added time charts to each of those items. And the blue section of the time chart is actual data for the company up to 2012, and the red portion is a plausible range of forecasts going out to 2017. What we need to know, though, is where that sales number on the left-hand side came from, that sales number of passenger journeys sold. Well, that comes from the number of people who fly with the airline and how often they do so. And this is a really important distinction. 75.8 million people flying once a year is not the same as 15.2 million flying 5 times a year. And even though that's a really important distinction, those numbers are not reported by this company, and they're not reported by any company in this industry either, or pretty much any company in any other industry. So what we've had to do here is just offer plausible estimates. We know roughly that this company's customers typically fly between 4 and 5 times per year, but we don't know any more than that. Now, I should also point out that we're only taking the analysis here through to EBITDA profit. The method can be extended and should be extended to the full income statement and cash flow analysis. So that's dealt with that top half of the income statement where sales and revenue come from. We follow exactly the same principle to figure out what's happening to the other half of the income statement, the costs. So there are the total operating costs made up of the costs of staff, aircraft, airports and routes, plus marketing expenditure and some other minor items. Follow exactly the same principle and you end up with this picture with staff costs being driven by the number of staff we employ, aircraft costs driven by the number of aircraft we have, airport costs driven by airports, and route costs driven by the number of routes that we choose to serve. So that is step 2 of the process. It shows how changes to the resources in the business drive performance. And it is a complete explanation of Ryanair performance driven by these particular resources in this case. I should mention that these are annual numbers, but you could do exactly the same analysis at more detail with quarterly or monthly data if you happen to have that. And certainly you could do that inside the firm as often as you felt you needed to do so. I should also mention this is not simply a diagram. It is a working, quantified arithmetical model. You could do it in a spreadsheet. It's not really a very intuitive way of doing it, and there are better tools for the task. And you can see this working model at the link I've provided here. You simply need any latest version browser to be able to see this model, to play with this model, and there will be other models in this series as we go forward. Now, if this is how the business system works, why don't we say so in our integrated report and include the data to explain it? So in the integrated report, we could say, here is our financial performance to date, plus how this has reflected revenue changes from customer growth, purchase rate and price changes, and how costs have moved due to changes in capacity, staff and product range. And as I say, we could and should extend the analysis to free cash flow. We can also, though, extract social and environmental consequences from this. For an airline, an environmental concern would be what's happening to carbon emissions. The company could reasonably argue that it is making a significant contribution to social cohesion by allowing friends and families to stay in touch with each other at low travel cost. They clearly have an impact on employment and skills, and there's very strong evidence indeed that the provision of this company's services to certain airports has played a quite significant role in the development of local economies around those airports. So in our integrated report, we could say, here's how our business activity and resources have changed the contribution we make to social and economic factors, and how they have consumed scarce inputs and created environmental outputs. And we would want to include time charts on all such social and environmental factors. We don't actually know what those are in this particular case, but it would be perfectly plausible to do so. Now, that example of the airline demonstrates a set of completely standard, tangible resources that apply in nearly every case. Customers drive demand, Supply is enabled by having capacity and staff and a product range that customers want to buy, and every business needs to worry about its cash. So this table simply lays out what those things are in the case of a manufacturer, a retailer, car maker, law firm or a pharmaceuticals firm, as well as the airline. Not all companies have exactly the same set. Some items are missing and some are additional. So in the minerals industry, for example, if you are a business that simply digs stuff out of the ground and sends it off to some commodity market, you don't know who buys the product and you don't frankly care. Such companies also feature an additional category of resources in the form of the reserves that they have. And those things need to be, and of course usually are, reported for companies of that kind. The car maker example shows that in some cases you need to have information and be concerned about intermediaries. You don't sell cars directly to the end buyer. Your dealers sell your cars for you, and we would want information on that. Car makers too would be concerned about the resources of their supplier network that enables them to do what they do. And in professional firms and other service firms, we aren't so much concerned with physical capacity like machines or production lines. The people themselves actually are the capacity of the business to do what it does. So now we need to move on to step 3, which is to understand how the quantities of these resources actually change. And to do this, we use a simple but powerful approach known as the stock and flow framework. Here is our estimate of Ryanair's customer base last year, 13.8 million people, and at the end of this year, 16.5 million. That's the stock of customers. And if that stock of customers increased from 13.8 to 16.5, then it must have won customers on the left-hand side and almost certainly lost some customers on the right-hand side. And those numbers have to reconcile. So those items on the left and the right are known as the inflow and the outflow of customers. Now this is nothing new. People already get this idea. It's just the way that their bank accounts work, and it's just the same as the relationship between the balance sheet and the cash flow. But what we need to recognise is this applies to all resources, not just cash. How does this work in the case of Ryanair? Well, here's the stock of customers and our estimate of how that customer base has grown up to 2012 and could grow to 2017. And on the left, we've shown how customer gains and losses could have led to the current number of customers at each point in time. But of course, that's not reported by this company, and it's not reported by any company in the sector. So once again, we've had to make plausible estimates. This has big implications, though, not just for sales, but also for the quality of that customer base. Having more customers is not much use in this case if those customers don't fly very often. We want more people who travel 5 times per year, not the same number of people who only travel once or twice a year. Now this too is a working model, and if you follow the link on this diagram, you'll be able to explore that model and explore how those win and loss rates of customers change growth in the customer base and change the sales rate. We can do exactly the same on the supply side of the business. The net change in staff, the net change in aircraft, airports and routes. But it turns out that net changes alone are not enough. You need to know the additions and the losses separately. The difference matters, but it's very rarely reported. In this case, you will have good data on aircraft bought and aircraft sold. You have patchy data on airports and routes that have been added and discontinued, but that's about it. You don't have the full set of information about the gains and losses on this picture. So in our integrated report, we could quite reasonably put this diagram up and say, here is how customer gains and losses have caused the net change in customer numbers in our business over recent years, and how these flows and other factors have changed the purchase rate. In the case of the staff, we could perfectly well include in our integrated report, here's how hiring and turnover have changed our staff numbers over past periods, and how that hiring and turnover has changed the average skills and experience. We would need an additional diagram to capture the impact on skills and experience, but it's simply an extension of this principle. And in businesses where different groups of staff may be key, you might want to break that down, not just have an overall picture for all of the staff in the business. You may want to focus on particular groups of staff who are critical. And of course, you can extract the cost of these changes, how much it costs to hire these people over that period of time. And you can do the same for capacity, for product range and other resources in the business. These flow rates too have social and environmental consequences. We're building human capital in the local economy where we're employing more people. When we increase our capacity, be it aircraft or airports, we are consuming raw materials in the construction of that capacity. And at the end of their life, there will be some generation of scrap and waste at the end. Ryanair doesn't keep its aircraft very long, so this company itself doesn't scrap the aircraft, but sooner or later they end up in the desert. And once again, we would have to include time charts on those social and environmental factors, but that again would be quite plausible to do. We've explained how the flow rates, the additions and losses of customers and all of these supply side resources of the business are so important. So if those flow rates are so important, how should we be reporting them? Well, this diagram is a way of reporting them, but what we do with cash is we have a balance sheet and we have a cash flow statement. The balance sheet says how much cash we've got at the start, at the end of the year, and our cash flow tells us how much cash came in and how much cash went out. Well, if these resources also are critical, why don't we report gains and losses in the same way? Customers at the start of the quarter, customers won, customers lost, and customers we've got at the end of the quarter. Here's a very common one. Nearly every company somewhere or other in their annual report will say something like staff are our most important asset. Well, if they're our most important asset, why are we not reporting gains and losses? Not just for staff as a whole, but for key groups. And the same applies to product range and capacity. So where in our annual reports are the customer flow statement and the staff flow statement and the other flow statements that should be telling investors and other stakeholders how these resources are changing? So now we come to step 4 in the process, which is to understand how decisions, external factors and existing resources give rise to those changes in the resources in the business. And we're going to focus first of all on the customer base for Ryanair. So here is that change on the right-hand side in the number of customers. This is the change that we have estimated. And on the left of that stock, we've got the customer win rate. Now, clearly, our decision on what fare to charge had some impact on our win rate of customers. But that's not the only thing that changed that. There have been external factors too, such as the recession, which hit consumer expenditure rates. But the other factors that are involved in this are the existing resources that we have. That growth in customers occurred, at least in part, because we opened operations at new airports and because we increased the number of routes between those airports. So those are the 3 standard sets of things that give rise to those flow rates of customers: decisions, external factors, and existing resources. And of course, adding resources is itself a decision. We decided to open new airports, we decided to add more routes. Now this picture isn't actually quite right, and we're just going to go on and correct part of that by looking at the outflow rate on the right hand side, the customer loss rate. So those same decisions and those same external factors didn't just affect customers' decision to start flying with this airline, they also affected the customer's decision to stop flying with it. So on the right hand side we've got the loss rate of customers, which is now varying because things are changing on the left hand side, and that gives us a not only an estimate of what the customer loss rate is, but also a revised estimate for what the win rate has been. So in our integrated report we could perfectly easily say, here's how customer gains and losses have resulted from our own actions, how they've been affected by changes in external factors, and how our efforts to develop other resources have actually influenced those flow rates. Now this is just one set of these relationships. within a more complete model of how this particular business operates. And you can find the full working model at the link shown here, sdl.re/Ryanair-model. So we've taken you through the four basic steps of the strategy dynamics method. I suppose just stepping back from this and thinking about the implications arising from this way of looking at how a business operates. Any business has some set of resources which explain its current cash flow. And if we did nothing else, those resources would gradually drain away over time. Our products would become obsolete, our capacity would become old and inefficient, our staff would drift away, and we'd lose customers and the business would decline. Therefore, every business knows they have to spend to sustain those existing resources. You spend on product development, you spend on maintaining capacity, you spend on hiring and training staff, and you spend marketing to keep your customers. That, though, is typically not enough for us. We actually want the business to grow, so we've got to put more discretionary expenditure and more effort into building those resources from the left-hand side. So you've got a choice here. You could have a very high free cash flow right now, except your business would be in decline and your cash flow would decline. You could stay exactly as you are and just put in enough to sustain the business, or you could put more back in and spend to develop the business and take that forward. That's not quite your free cash flow, of course, because you have to pay interest and taxes. But after you've done that, that's what's left to share out with the business owners. So what are the implications arising from this approach for the aims that the integrated reporting movement is trying to achieve? Well, strategy dynamics creates working business models that link strategy to performance and to the social and environmental impacts of the business. If a business has multiple customer segments or different staff groups that are important or different categories of product, then you may need to segment the effort and segment the data to really get a handle on how the business is performing. And for a corporation that consists of multiple business units, not just a single simple business unit as we have in the case of Ryanair, you may need to repeat the approach for each of those business units. This, though, implies a lot of detail, much more than could ever conveniently be published in a typical company annual report. Although summary diagrams alone, rather like we've shown in this presentation, would communicate much of what it is we need investors and other stakeholders to understand. There is an alternative, though. We could actually give those stakeholders, and in particular investors, access to the working model. And what we'd effectively be saying is, here's how our business actually works and how it actually delivers performance with recent data on that performance. And you feel free to use it to test your own forecasts for the business. We're not going to give you a quarterly forecast or a year-end forecast. We're giving you the business model. You can make your own forecast with that. Now, unfortunately, this would need firms to be extremely open with data about those business factors. And that's on top of the financials that they disclose already. However, if you want to fulfill those aims that the integrated reporting movement is pursuing, there really is no other way to do it. This is how it has to be done. So thank you for your attention to this short presentation. And if you want to find out more about the approach in general, you'll find that explained at strategydynamics.com, including information on courses you can take to learn how to use the approach. And you're welcome to email me with any inquiries you might have about the method. That's kim@strategydynamics.com, or join the discussion at the Strategy Dynamics LinkedIn group.